We are going to delve a little deeper into the Japanese candlestick. It evolved in Japan way back in the 1700s. Developed, the credit to this goes to a Japanese rice trader by the name of Munehisa Homa. He was the one who is supposed to have invented this type of a trading. During those days, almost 300 years back, there used to be trading in rice in Japan in the Osaka Stock Exchange. So the link between the price and demand and supply of rice was captured by the traders using this methodology. Even during those days, people realized that in the short term, prices are run more by emotions than on any fundamental factors. So this is a bearish candlestick. What does it mean? This is a daily candle. You can have it for any periodicity. So you can have an hourly candle, you can have an half-hour candle, you can have a weekly candle, you can have a monthly candle. So this is where the price opened. This was the high of the day. This was the low of the day, and this is where it finally closed. Because the closing price is lower than the opening price, the shape, the color of the candle is red. So this is the body of the candle. This is where most of the price action was concentrated during the day. These two are sometimes called as the wick or the tail of the candle. So this indicates extreme ranges for the day. In the bullish candle, this is where the price opened. This was the low of the day. This was the high of the day, and this is where the price is closed. Because the closing price is higher than the opening price, it is a green candle. So this is how it has to be read. Let's have a look at some single candlestick pattern. The trader looks at just a single day's price action, and if he gets his pattern right, the trade can be very, very profitable. Important thing is the length of the candle. The length of the candle should not be short because it does not tell you anything. All right, it only tells you that trading during the day was lackluster, it was subdued, there was not much buying or selling interest. So the length of the candle has to be significant. The first one that we are going to discuss today is the Maru Bozu. It is a candle which does not have any tail. A Maru Bozu can happen anytime. It can happen in an upwardly trending market. It can happen in a downwardly trending market. It can happen in a sideways market. But the significance of a Maru Bozu, for example, the markets are downwardly trending and suddenly you get a candle like this, okay, where the opening price is the low of the day and the closing price is the high of the day. This is a bullish Maru Bozu. What it means is probably the sentiments have changed in the market. A lot of traders give importance to this candle. You can come to a view just by looking at the price action for a single day. So you do not need a prior trend to trade the Maru Bozu. So a green candle tells you that this is probably the time to go long on the market with the stop loss of this level, which was the low of the day. And this is a bearish Maru Bozu. If it happens with the volumes, then it should be considered significant. This is an indication that traders are likely to trade on the negative side or on the bearish side. So if you are planning to go short in the market, this is a good candle. You can short the market with the open high as a stop loss. The trader who wants to trade the market knows that this is a time for me to go long. Some of them will take the trade on the same day. Some of them will wait for one more confirmation. If the candle is very small, then it should not be considered significant, and one can avoid that Maru Bozu. And similarly, if the candle is very long, for example, the candle is in the range of 8 to 10%, then what happens is the trade becomes risky because your stop loss is very far away from where you would be initiating the trade. So ideal Maru Bozu to trade would be about a 4 to 5% type of a candle.